Welcome to the REI Diamonds Show with Dan Breslin, your source for real estate investment jewels of wisdom.
Welcome to the REI Diamond Show. I'm your host, Dan Breslin, and this is episode 119 with Paul Sloate as we present the fourth quarter 2018 quarterly market update. I recently read Daniel Lapin's Thou Shalt Prosper, a tome on being spiritually comfortable with getting rich. Great read, especially if your income is rapidly rising or you'd like it to do so. One of the takeaways for me in reading Thou Shalt Prosper is paying attention to the trends happening in the world around me. Specifically, watching what's going on in humanity, the economy, news, political headlines, basically the world around us, and spotting the patterns of the way things work. It's the lessons I learned reading that book that originally led me to host Paul for these quarterly market update episodes. Over the last 3 years since first meeting Paul, the lessons I've learned from Paul on these quarterly market update episodes has helped me to identify and capitalize on trends happening right now in the real estate market. I've even made six-figure profits on some of those deals. It's taken me several years to get serious about studying the economy in general to develop a better sense of risk versus reward in my deals, and much of that perspective has been developed right here on the show by many of the guests, but specifically from my time with Paul Sloate. It's no secret that the U.S. economy is strong right now. If you're like me, you're making hay while the sun shines, working around the clock to get as many deals done as possible before the economy changes again and the real estate market shifts, which at some point will happen. Wouldn't it be nice to have some idea on just how long we have left here? Let's bring Paul on to share the registered investment advisor's perspective on the real estate market we're operating in today. All right, welcome back to the show, Mr. Paul Sloate. How you doing today?
I'm doing well, Dan. How are you?
I am also doing well. It's about the middle of September here. We're having a nice, crisp, warm, little last blast of summer, it looks like in Chicago here. It's like about 75, 80 degrees outside. By the time the listeners are actually taking this in, it probably will not be that nice.
Oh, my goodness. Well, I don't know. We've got something similar here in Philly, so it's pretty okay out. It's not raining for a change. Had a pretty rainy summer this year.
All right, so good to hear. Glad all is well, as is on my end. So we have been in unprecedented boom times, and it's seeming like the ticking time bomb everybody's waiting for. Times are good, but I'm starting to hear that rumblings of the late stage. I mean, we've been hearing it for a while, but I'm guessing you'll have a little more detail and the update of what we're looking at here in the economy, Paul. So I figure we'll turn it over to you.
Well, that sounds good, Dan. So let's start with the big picture, and then we'll pull into the real estate pieces that your listeners will find of interest. But the big picture is we are in a late cycle economy, and we've moved into those classic end stages. And those classic end stages typically mean you have rising inflationary pressures in the economy. So in this case, labor is beginning to get its piece of the pie, and we expect that to continue. And that's not going to go away even once we have the next recession. It might go away briefly, but it's going to become a bigger and bigger issue for those who have to hire labor. And then the other thing that's happening is that materials have been inflating, and many of them have sort of stopped inflating for a variety of reasons. For example, timber went to record prices and then has pulled back and is kind of in a waiting game here. Or copper has pulled back because of the potential for a, quote, slowdown in China, which we don't believe, and we'll talk about that in a minute. But the U.S. economy is in a late cycle stage, and you would expect rising capital investment, rising demand for money, and rising interest rates. So let's talk about what this means for some of our real estate-oriented audience. Firstly, it's going to cost you more money to borrow to fund whatever real estate you are either constructing or buying. And that won't go away. And in fact, we think that we are in a secular upturn for interest rates and inflation for a variety of reasons. And we'll start with the U.S. needing to grow the economy faster, and typically faster growth is associated with higher levels of inflation. Secondly, the government has quite a few liabilities sitting on its balance sheet, and typically when debt gets high and governments have lots of liabilities, what they do is they inflate away the liabilities and they inflate away their debt. And we expect that to occur especially in the 2020s. So that's something for your listeners to keep in mind on a longer-term basis, that we are going to have real inflation after 2020, and especially after the next recession. Now, the types of rumblings that you're seeing around, Dan, are probably similar to things I see that are typical late cycle things, such as advertising on the radio for courses on home flipping. When I see that, the last time I saw that kind of stuff was when I saw advertisements for websites back in 2005, 6, and 7 for things like condoflip.com, for those of us who remember. So those are classic things that occur at the end of a cycle. So we think you are late cycle. If we look at the fundamentals, housing supply is beginning to catch up to housing demand. We're not quite there yet, but we would expect by 2021 we will be. The other thing that's going on clearly is there is a slowdown going on in the housing market. Sales of homes have been down year over year for a number of months now. We had expected this. We had written a piece about a year and a half ago expecting this coming slowdown. And we think that fundamentals will continue to support what we would call a late 90s environment. What happened back in the late 90s for housing was that things slowed and went sideways for a number of years until the next recession occurred, and then housing had another leg of a cyclical upturn. So what we expect to occur is that housing is going to go sideways here because, number one, prices have gone up significantly. Mortgage rates have started to go up quite a bit. And so incomes need to catch up to what it costs to buy a house. And where this is most easily seen is in the entry-level housing. So, for example, Pulte Corp., which is one of the largest home builders in the country, reported orders down single digits overall, but in their entry-level housing, orders were down over 13% year over year. And we think that reflects two things. Number one, that prices have gone up a lot. And number two, that mortgage rates went up. And it basically rationed a whole number of people out of the marketplace. And then the second thing that was interesting, which a number of home builders have reported on the public side, and which is also reflected in the private data, for the same house, they are getting 0% increases year over year. And we would say that that is a leading edge of what we think is going on in the housing market, where prices are flattening out. Inventories for resales of homes have been ticking up, and in fact are likely flat to up now on a year-over-year basis. And this would be the first time in probably 4 years that we haven't seen down inventories on a year-over-year basis. And as we all know, in the laws of supply and demand, when supply catches up to demand, prices stop going up. And if enough supply comes onto the market, prices are forced down to clear the market. So that's something to watch carefully, is the amount of housing inventory and whether it stabilizes here or whether it continues to go upward, which would mean that pricing likely would be down next year for homes. So in addition to interest rates going up, we now have home prices stalling out. So if you're in the business of owning homes and renting them out, you have to think carefully about the marketplace, because you're not going to get bailed out by the price of the house you bought going up. You're going to have to make the economics work by renting the place and having enough cash flow from the rental to ensure you more than cover all your costs, and then you throw off some cash so you get a proper return on capital. And then the other thing you have to think about here, for those in the home flip business, is my costs are going up, but the price at which I can sell the home is not. So you have to really know what you're doing and control your costs, else you will not make a profit on your home flip. And if selling homes starts taking longer, that means your cost of financing the property is going to go up, because you're going to have to hold the property for a longer period of time. And it doesn't matter whether it's here in Philadelphia or out in Chicago or down in New Orleans or out in LA. All these markets are seeing a slowdown, and this is something we've talked about before on your program, Dan. The other thing is you have to think about is, what are rents doing? Now, I know certain markets such as Philadelphia, Chicago, Atlanta, Miami are a little more important to your listeners. So what I do know here in Philly is that effective rents are down year over year. I know they're kind of sideways in Atlanta. I know they're down marginally in Chicago. I know that in Miami, they continue up, but Miami's a little bit different type of market. But in general, if we look at Philadelphia, Atlanta, Chicago, also what I know is going on in places like New Orleans or LA or Denver or other major markets, rentals rates are really stalling out. And we expect this, and we don't think it's going to get any easier on the rental side for two reasons. Number one, we have adequate supply on the rental side. And number two, the demographics are going to start to look worse on the rental side, especially post-2020. As we've mentioned before on the show, from 2020 to 2025, there will be 0% growth in the key demographic that rents, and that will have implications not only for apartment rentals in the major metros, but for all the home rentals where people have accumulated portfolios of houses in the suburbs in order to rent them. And I'll just give you one piece of anecdotal information from my neighborhood. There's a house that was put up for rent, and it's been sitting there, and it is not rented yet, and I suspect they will need to cut the rental rate in order to move the property. So I think that's something to be aware of. We're still positive on entry-level housing over the long term. We think we're in for this pause like the late 90s. I know we've mentioned that before on the show. And if you remember, that pause went from 1998 to 2002. So you had a 4-year pause. If we were to have a 4-year pause, that would coincide with what we think will likely be the bottom of the next recession. We'd have 2018, 19, 20, 21, and into 2022, and we think we're likely going to have a 2021, 2022 recession. Now, that could be a 2020. I think it will extend, the economic cycle will extend into 2021, depending on a variety of factors and some of the cycles outside of real estate that we see. But if we were to have a recession, let's say 2021, 2022, we'd have a bottom sometime, the Fed would start cutting rates, and you'd get a bottom in housing and a new upcycle starting in late 2021 or 2022, and that would give you your 4-year pause. So that's just a couple of things that we're thinking about on the housing side. There are other classes of real estate where we continue to be concerned, such as self-storage, where there's a huge amount of capacity in the pipeline. If you happen to be in the Carolinas, you may get lucky, because what happens when you have a hurricane is that people have to fix their houses. They salvage the stuff they can and they stick it in storage, typically while they're waiting for their home to be repaired. And then once the home is repaired, it comes out of storage. So you get a bump in self-storage. So we can thank Hurricane Florence for creating, if your self-storage facility is not destroyed by the hurricane, incremental demand. So that's just something for self-storage in the Carolinas, but in general, self-storage is building too many square foot of property. And that will be an issue, especially in the next downturn. There are some other areas to keep an eye on, but the offset here is that because costs are going up, that is inflating the cost of building replacement supply, so replacement values may hold in areas such as hotels or commercial real estate. The other factor that your audience should be aware of is the coming wave of turning construction into assembly, as in building tinker toys. So let me explain what I mean by this. What I mean by this is that for new construction, what we are starting to see is significant modularization of home construction. In other words, much will be constructed off-site and then merely assembled on-site. Doing this can lower the cost by up to 30% per square foot. So the thing we have to keep in mind with housing, and especially for new housing supply, is that we may have a modularization of housing, which would actually make it cheaper to build a house, which is something interesting which has not occurred for 50 years. Because what we will be doing is cutting out labor on the job site and replacing it with manufacturing capacity, which has typical productivity cycles every year, where it can do the same for less. So we're starting to see this creep into construction. The other piece of that is on the commercial side, is the ability now to engineer a whole building up front at a fraction of the cost it used to cost. And in addition, you can effectively cut out the change orders on a building because you can engineer them out. And that can save you 10 to 15% on construction of, let's say, a $50 million building. So if we were to think about all this, what you could have coming to the whole real estate business is a new way of building things that significantly cuts the cost of constructing a building, whether it be a home or whether it be a large commercial structure. And if this is where the industry is going, then one has to think about the implications for what it means for pricing over the long term, given that the cost to build will drop. So those are just some things we think about over the long term, and we're going to be keeping a very careful eye, but it's something your listeners should be aware of, because we do know that at least in this area, we know several builders that are experimenting with modularization of home construction, and it's cutting their costs significantly. And it's something to just bear in mind, because ultimately, if enough people can cut their costs and becomes widespread through the industry, it might put pressure on new home pricing, which would then feed back into the resale market. So these are just things to think about over the long term. But over the short term, what we see is we're late cycle. We've seen capital investment picking up in the economy. We see inflation picking up in the economy. We see interest rates have had a little run here and may have another run. And we see the Fed tightening, and dependent on how the Fed tightens and a number of other factors, which I don't want to take a lot of time to go into here, you can see the economic cycle ending anywhere from 2020 to late 2021, dependent. So as we've been telling our clients, we'd recommend to your listeners, and we've been recommending for a year and a half now, any real estate you don't want to hold through the next downturn, you should be liquidating. And that is my update for today, Dan. You have some questions for me. You always have questions for me.
I do. I have some comments, some questions, some insight here that I think I want to add. I'm not sure that you highlighted enough the impact, the potential landmine, the nuclear bomb that could be on the horizon if this modular housing trend continues. As you were talking about that, I was making some notes here, and, we're lowering the cost potentially by 30%. Am I correct in assuming that could potentially indicate a large deflation of value for certain markets where the land is available to build new construction in an area at a much larger rate? Could this be like a big-time problem for certain cities, 10 years, 15 years out?
I think it could, especially cities where there's a lot of land available. It could be a problem. And in fact, I was reading major home builders looking into building factories to do this. And the factory would need to be located within 200 miles of where they were building. But 200 miles is a large radius, right? And so you start thinking about it, and yes, what it could do, I'm not quite sure, it could lead to a little bit of housing deflation, but the other piece it could do is really put a cap on home prices for quite some time, right? And that's probably going to be the near term. And whether it ultimately leads to actual housing deflation, I think will come down to what is the inflationary or deflationary background in the overall economy. But it does have the potential to create significant deflation in the housing market. And it's kind of like the elephant in the room. It's kind of like people have been working on this for over a decade. In fact, for 15, 20 years, right? You always had prefab in the industry, but it never got to the point where it was so economic that it could have a massive impact on the cost of construction. But what you've had is between robotics, between the computerization here of doing things, you now have the ability to really apply this in a major way to the industry, and I view it as a step function change in how construction is going to occur over the next decade. And by 2030, the way you build a building is going to look completely different than it does today. Is that
a couple of the observations? A couple of the observations I have on this myself, Paul, from my own experience. If we take a look at Atlanta compared to Philadelphia or Chicago, Philadelphia and Chicago, for anyone listening in the opposite city or anywhere else not familiar, both constrained real estate markets, tougher to get permits in Philadelphia, Chicago than it is Atlanta. There's a lot less land in both Philadelphia and Chicago available for development, especially when you take and you add in the natural boundaries like the rivers and Lake Michigan, compared to Atlanta, which has no real natural boundaries in any of the 360 degrees surrounding. It's wide open land. But we have here in Chicago, and same with Philly, we have unions who kind of dictate some of the building code, and we've seen, I've seen modular home construction take place in Philadelphia. I've experienced that. I've seen the cost benefit, and it was marginal. It wasn't 30% like we're, anticipating potentially could happen down the pike. To your point, here in Chicago, there is almost none, if not zero, that I'm even aware of in the city, residential new construction built modularly. No infill construction, no, and the reasoning, so I'm told, I've been party to some of the pushes to try to get it, actually to happen in the city. We have not been successful so far. But the unions have specific building codes, and the modular homes are building it for national building code, not what needs to happen in the city of Chicago. So it's proved a challenge. But on the other side of that challenge, Paul, we have Loyola University. I'm not privy to the blueprint, so I only see the trucks bringing the sections in and putting up these hotels and dormitories and these 4 or 5 story with commercial space on the first floor. But they are being built in record time. It's a mind-boggling experience to see these properties go in like 4 or 5 months flat from a hole in the ground to a complete building with a CO, and it's being done through the modular sections being brought in on the trucks from somewhere else where they're being constructed. And it's interesting to see it taking place, right before our eyes here as it's transforming our city in Chicago.
Yeah, I actually went to visit one of these modular construction facilities down in Baltimore, and what was fascinating was I saw how they did this, and there's a lot of robotics, and by the way, the facility is spotless, the working area of the facility, and they had the trucks lined up outside with the various sections that were going out, and yeah, this is coming. Now, maybe there's building codes in places like Philadelphia and Chicago that currently stand in the way, but I think ultimately the economics are going to win, and if this truly is less expensive, as it may appear to be, it's going to find a way to incorporate whatever needs to be done to meet the building codes, so that the people building the building will get to enjoy the savings and economics that are available.
One of the other topics here before we wrap it up, Paul, we talked about the environment in the late 90s. I vaguely remember I was 18, 19 years old, just starting college, vaguely aware of what was going on in real estate. I do remember paying attention because it was my dream to flip houses someday. I was paying attention to the real estate prices. It was just when I started in my life to pay attention to, the numbers. But I remember it being sideways. The houses in the neighborhood I grew up were selling right around $100,000 right outside of Philadelphia, and they seemed like they were stagnated until it was 2002, 2003, 2004 when the prices took off and the properties went up like 40% in value from 2002 through 2006 or so when they finally leveled off, maybe even a little more than a 40% during that time. Can we just shed a little bit of light? I am aware that there's a different type of we kind of have like a cost to build. We have supply and demand. And then like what was driving the supply and demand in the 90s, maybe the affordability versus like what happened when we had.
So let me a little stage for what happened by the time you got to 1998. Okay.
Okay.
So I'm a little older than you. And so in 1998, I was the ripe young age of 37. So I'm a little older. But what I can tell you is that from 1987 to 1992, there was a downturn in the real estate market, very similar as that from 2007 through 2011. Okay? A condo in New York City that went for $250,000 in 1987 went for $110,000 in 1993. So you had a very vicious real estate downturn for pretty much the same reason. The banking system went bust. Okay? Now, what happened is from 93 to about 98, you had a massive recovery, just like we had. And then the market went sideways for 4 years. And so you also had in 98 this transition from mid-cycle to late-cycle economy. By late-cycle economy, you went into a major capital spending cycle. Now, I see us going into a capital spending cycle not as extensive as then. The big capital spending cycle, I believe, for the country is going to be in the 2020s. And we can get into that for why it will happen and what it will be, but that's a whole separate discussion. But the point is that we made this transition. Inflation was heating up. Interest rates were going up. Labor rates were going up. So all the same kinds of things that are going on today. So when I look at these environments, they are pretty much the same. And that's why one of the reasons we expect things to go sideways for a while, because incomes need to catch up to what's gone on until now. Is that helpful, Dan?
It is, yeah, and that's the stage I want to set for anyone listening right now is, what to expect here is something different than what we lived through in 2008, 9, 10, a different type of real estate downturn. So I guess, people are saying the correction's coming. Yeah, it probably is not going to continue at 6 to 10% appreciation or more in certain areas. But, leveling off and seeing something like happened in the late 90s is exactly what I would expect to take place myself. It's a different kind of slowdown than I experienced in all of us in 2008.
Right. And I think that what's going to happen this time is you go sideways, you have this period of consolidation, and then somewhere around late 2021 or 2022, you get your next leg up. And that will be a pretty robust, I think, environment in the economy. And I think you should have pretty good growth in the economy for a variety of things. So it'll look more like, I think, the type of growth we had in the 90s and early 2000s than what we experienced over the time frame from 2008 until 2016. And that's another thing you have to think about with real estate is, what's the economic growth environment going to be, right? Because if the economy grows at 2%, that means demand for your property is going to grow at X. But if the economy grows at 3%, demand for the property type will probably grow at X plus, right? Growing economy lifts all ships, some more than others. So it's just something to think about. Same with the shrinking economy, right? Shrinking economy drops all boats, some more than others. So anyway, that's kind of how I would view it, and I would agree. This is not going to look at all like the last downturn. And people thinking you're going to have the same opportunities to buy properties, they're not going to really exist at anywhere near the same level. And the other thing is you've had a lot of new people enter the industry, and as a result, you're going to have a lot more competition for the opportunities that do arise.
So my final question, comment, maybe we'll address for next time, would be the bogey of the shared economy. So just this morning, I was at a breakfast with some of the Airbnb executives, along with AirDNA executives, and I think it was a HomeAway exec who showed up for that as well. And this is kind of something coming from left field where property's in the right area. As my listeners know, we have a guy who turned a negative $35,000 a month cash flow into a positive $45,000 a month cash flow on properties that he was in the process of fixing up and flipping on the retail market in a little bit better areas. You're not going to get away with this in the $100,000 or less property. But, as a potential risk, cushion, a hedge against the risk, some of the listeners are looking into the Airbnb strategy. So I'm curious to know if we see, any other economic.
So explain to me what you mean by the Airbnb strategy. You mean just renting it out on short-term lease basis, correct?
Yep. So I have one. I got $411 for an apartment that I have, a 3-bedroom apartment. I kind of keep it almost as like a corporate housing for, I'm in 5 different markets. I have partners who come to town, family, etc. When I have no family or friends staying in that unit, I rent that out for anywhere from 1 day to however long that guest wants to stay, and they're paying an average of $165 a night or so. And you have to provide furniture, furnishings, cookware, etc. But the cash flow is probably 150% or more of the rent you could expect to get from a market rate long-term tenant.
And I think that that's okay given where you are in the economic cycle. So let me just talk about hotels. But as you know, Dan, hotel rooms that business is pretty cyclical to the economy. I think we'd all agree with that, right?
Mm-hmm.
And so that strategy works for now, for sure. The real question is what happens is, let's say we get into recession in 2021, and then what's the recovery period? And what does it do to your occupancy rate and rental rate? But, I haven't really studied that model. And then the other piece of that would be is the regulations by the municipality, right? Now, I don't know what Chicago regulations are, but, in places like, in New York City, they've started to clamp down on this, and they want to make sure that they're getting their piece of the pie. So if you're renting it out as a effectively hotel room or short-term rental, they want to make sure they're collecting hotel taxes, right? So you got to make sure that you're careful to be within whatever the municipality would allow. It's an interesting concept. And I think you're correct. For the right piece of real estate in the right area, I think it would work well, right? Because short-term rentals, you always get more, right? You get a premium than for a long-term rental. The trade-off is it tends to be more cyclical, and you're going to have a higher vacancy rate. And so if the economy is not as good as it is today, what does that do to the overall vacancy rate? But I think those are questions, and that's going to really come down to the local market plus what's going on in the overall economy.
All right. Sounds good, Paul. So do you have some contact information you'd like to share if anybody would like to reach out and get in touch with you?
Sure. You can reach me by filling out the form on our website at www.greendrakeadvisors.com. Or you can call our offices at 687-7766610, area code. Again, that's 610-687-7766.
All right, Paul. Well, hey, I got a couple pages of notes here. As always, I'm grateful for the information, the insight, and the perspective. I thank you for coming on the show today.
All right. Well, thank you, Dan. I look forward to next quarter's update.
And thank you for tuning in to this episode of the REI Diamond Show. You want to keep an eye out for the next episode. You've heard me talking about Airbnb over the last few episodes. It is a trend happening in real estate, and I believe will continue to grow. You know I'm all about the numbers, and I found an information system which is like the MLS of Airbnb. It's called AirDNA, and I've invited the founder and CEO, Scott Shafford, to share his analytical, numbers-driven approach and system for selecting the best properties in the best cities for Airbnb short-term vacation rentals. You won't want to miss it. If you are interested in a pre-release of the next episode before the email goes out, please subscribe on YouTube or one of the podcasting apps, including iTunes, Google Play, or Stitcher. And if you'd like to check out a free download of my book, Become a Wholesale Real Estate Master, please go to reidiamonds.com. Are you interested in getting in touch with me? If you have a deal for sale, or maybe you'd like to suggest a guest to come on the show, you can reach out to me directly through reidiamonds.com. I am always buying houses, so I am always looking for deals in Chicago, Atlanta, Philadelphia, Miami, and Tampa. So if you have a deal, preferably a deal I can fix and flip for profit, please send it over. reidiamonds.com. Also, at that site, you can check out available profitable real estate deals in those markets and the entire archive of the REI Diamond Show, totaling more than 119 content-rich, money-making, idea-packed episodes. Accredited investors are already earning double-digit returns, passively investing in real estate. Are you? If you're interested, you can sign up to receive private mortgage investment opportunities via email by going to superchargedreturns.com. Those private mortgage investment opportunities typically return capital, pay you back within 90 to 180 days, so they're great short-term investments. Thanks again for tuning in to the REI Diamond Show. Dan Breslin here, signing off.
Thank you for listening to this episode of the REI Diamonds Show with Dan Breslin. To receive email notifications of new weekly episodes, sign up at www.reidiamonds.com.